Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Fiserv Inc. annual report. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price to crash. The sudden and drastic decline of a company's stock price is often a result of a combination of factors. One major reason is poor financial performance, such as declining revenue or increasing losses. This can be due to various reasons, including decreased demand for the company's products or services, increased competition, or failure to adapt to changing market conditions. Another possible cause of a stock price crash is negative news and announcements from the company itself. This could include revelations of internal issues, such as corruption, mismanagement, or regulatory noncompliance. External factors such as economic downturns, industry-wide trends, or global events can also contribute to a decline in stock price. Additionally, changes in leadership or management can sometimes lead to a decline in investor confidence and subsequently the stock price. This could be due to a lack of experience, poor decision-making, or failure to execute on strategic plans. Lastly, market sentiment and speculation can also play a significant role in causing a stock price crash. If investors become pessimistic about a company's prospects, they may sell their shares, leading to a decline in the stock price. This can create a self-fulfilling prophecy, where the decline in stock price reinforces investor pessimism. In conclusion, a stock price crash is often the result of a complex interplay between various internal and external factors. Understanding these causes can help investors make informed decisions about their investments. The primary drivers of revenue growth for a company can be attributed to several key factors. Acquisitions, such as those made in 2025, have significantly contributed to revenue growth. Electronic payments transactions, particularly in the merchant segment, also play a crucial role in driving revenue upward. Additionally, subscriber funds and fees from merchant alliances accounted for under the equity method are other significant drivers of revenue growth. On the other hand, several factors can lead to a decline in revenue. Deterioration in economic and market conditions can have a negative impact on revenue, as can changes in contractual terms or scope. Variations in historical transaction, volumes and prices can also affect revenue negatively. In terms of segment-specific revenue growth and decline, the merchant segment experienced growth in processing and services revenue, but a decline in product revenue. In contrast, the financial segment saw growth in both processing and services revenue and product revenue. Other factors that can impact revenue include changes in depreciation and amortization, capital expenditures, and system-driven transactions based on contractual terms with customers. Overall, understanding these drivers of revenue growth or decline is essential for making informed business decisions and developing effective strategies to mitigate potential risks and capitalize on opportunities. The net income of the company experienced significant fluctuations between 2023 and 2025. While there were instances where it increased, such as a $349 million rise from 2024 to 2025, other periods saw substantial declines, including a 49% drop from 2023 to 2025. The profit margins also underwent changes, with operating income margin decreasing by 1% from 28.7% in 2024 to 27.5% in 2025. The reasons behind these fluctuations were varied and included higher payments, data processing costs, vendor spend, non-cash settlement charges, impairments, and foreign currency exchange losses. In some instances, the company's profit margins improved, such as a 0.9% increase from 15.6% in 2024 to 16.5% in 2025. However, other periods saw declines, including a decrease of 1.9% from 40.2% in 2023 to 42.1% in 2024. The company's profit margins also varied across different segments, with the merchant segment experiencing a margin of 34.6% and the financial segment having a margin of 45.3% in 2025. Overall, the net income and profit margins of the company underwent significant changes between 2023 and 2025 due to various factors affecting its operations. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. According to the latest figures, the net cash provided by operating activities has reached an impressive $6,062 million in 2025. This substantial increase suggests that the company is successfully converting its profits into cash, which is a crucial indicator of financial health. This positive trend is a testament to the company's efficient management and operational strategies. The ability to generate significant operating cash flow enables the company to invest in growth initiatives, pay off debts, and reward shareholders. Furthermore, this positive cash flow also reduces the risk of liquidity crises and provides a buffer against unexpected expenses or downturns in the market. Overall, the company's strong operating cash flow performance is a key driver of its financial stability and growth prospects. As the numbers continue to rise, it is likely that the company will maintain its position as a leader in its industry. The company's financial situation has undergone significant changes in terms of debt levels and interest expenses. According to the extracted summaries, the total debt has increased from $23.2 billion in 2024 to $26.4 billion in 2025, indicating a substantial rise in debt levels. Furthermore, the short-term and current maturities of long-term debt have also seen an increase, from $1.11 billion in 2024 to $1.24 billion in 2025. In terms of interest expenses, there is a clear trend of significant increases. The interest expense, net, increased by $298 million, 25% in 2025, and the change in interest expenses from 2023 to 2025 shows an even more substantial rise, with a 22.5% increase. This indicates that the company's financial obligations have become more burdensome over time. Overall, these changes suggest that the company is facing increased financial pressures, which may impact its future performance and stability. The company's performance across various segments and regions has been mixed. On a positive note, the small business segment has seen significant growth through new partnerships and expansion into high-growth industries such as healthcare and e-commerce. This segment has also made inroads into multiple international markets, further contributing to its success. In addition, the enterprise segment has experienced growth driven by the adoption of integrated omnichannel operating systems and payment solutions accessed through Commerce Hub. The company's end-to-end, omnichannel solutions for stored value programs have also seen revenue and customer engagement increases. However, there are areas where performance has been less impressive. Within the merchant segment, processing has partially offset revenue growth, while banking within the financial segment has also had a negative impact on overall revenue. Despite these challenges, the company's total revenue remains strong at $10,140 million, with 5% growth driven by both small business and enterprise segments. Management is optimistic about the company's outlook, citing significant revenue growth of 10.5% in the merchant segment and 12.1% in the financial segment from 2023 to 2024. The company's transformation program is a key driver of this growth, aimed at improving client experience through increased vendor spend and personnel costs. Operating income has also expanded by 20.2% in the merchant segment and 7.6% in the financial segment. Management is prioritizing operational efficiency and cost reduction efforts through its transformation initiative, while actively managing risk through derivative instruments to hedge against changing interest rates and foreign currency rate fluctuations. The company's strategic initiatives are driving revenue growth and operating income expansion, with a focus on recognizing revenue at the standalone selling price when the customer obtains control of the product or service. In terms of strategy, management is targeting a long-term leverage ratio of 2.5 to 3 times consolidated net income. Acquisitions are also playing a key role in expanding the company's footprint and capabilities in various markets. Overall, management is focused on driving revenue growth, operating income expansion, and operational efficiency through strategic initiatives and risk management efforts. The company has made several significant acquisitions and divestitures over the past few years. In terms of acquisitions, the company issued $2 billion, 2.175 billion euros, and $1.75 billion of senior notes in August 2025, May 2025, and August 2024, respectively. Additionally, it distributed certain merchant contracts for a minority partner's membership interest, resulting in a gain of $89 million. In terms of divestitures, the company terminated its U.S. defined benefit pension plan and UK defined benefit pension plan in September 2023. A buy-in insurance policy was entered into in March 2024 to cover the UK plan. The settlement of these terminated plans was completed in the fourth quarter of 2024. The company also made two significant sales, resulting in a net pre-tax gain of $37 million and cash proceeds of $210 million in 2025. These transactions demonstrate the company's efforts to optimize its portfolio and reduce its liabilities. The company's financial activities have been notable in recent times. One significant development is the purchase of shares by the company itself. This move indicates a strategic decision to reduce the outstanding share count and potentially boost shareholder value. A total of 32,200,000 shares were bought back, demonstrating a substantial commitment to this initiative. Furthermore, the company has set a limit for future purchases at 45,874,150 shares, suggesting that it intends to continue investing in its own equity. Supply chain disruptions pose a threat to business operations. The extracted summaries reveal concerns regarding supply chain disruptions that could have a significant impact on business operations. According to page 16, disruptions to third-party delivery service providers and shipping services can lead to increased lead times, shortages, or higher costs for certain materials and components. Furthermore, page 32 highlights the potential material adverse effect of global supply chain disruptions on the company's business, results of operations, and financial condition. This suggests that any disruption in the supply chain could have far-reaching consequences for the company. Additionally, page 39 indicates that higher payments to distribution partners had a negative impact on operating margin in the merchant segment. While this is not directly related to inventory buildup or supply chain disruptions, it does highlight the potential risks associated with managing supply chains and distribution networks. In summary, while there are no concerns about inventory buildup mentioned, the extracted summaries do reveal significant concerns regarding supply chain disruptions that could have a material adverse effect on business operations. That concludes the financial summary for Fiserv Inc. Feel free to comment below, and I will be happy to answer them when possible.